Welcome back to The Deep Dive, the show that's all about finding the signal in the noise of corporate reporting.
Today, we were really digging into the Q3 2025 season, and we're starting with a fascinating one, a company right in the middle of a huge pivot, NCR Voyix.
Right. For decades, you hear that name and you think hardware, cash registers, point-of-sale systems, but they're trying to become a software and services company.
Exactly. And our mission today is to look past the headline numbers, break down their strategy, and really pinpoint the catalysts that are driving this whole transformation.
Okay, so let's jump right in, the financials. For the quarter ending September 30th, total revenue was $684 million. That's actually down about 3% from last year.
And that's a number that might, scare some people off initially. But the story here is all about the quality of that revenue.
Because that decline was from hardware, right?
Precisely. Lower hardware sales and some one-time software deals from last year. The number we really care about, recurring revenue, was actually up 5% to $425 million.
And that's the sticky, predictable stuff, the foundation of a software business.
It's the cornerstone of their entire new identity.
So even with revenue slightly down, the profitability story was completely different. Adjusted EBITDA hit $125 million. That's a 32% jump.
It's a massive jump.
How much of that is real, sustainable improvement versus just, temporary gains from all the restructuring they're doing?
That's the key question. And that margin expansion, almost 5 full percentage points to 18.3%, it seems pretty solid. Management said it was basically two things.
Okay.
One, the cost cutting they've been talking about is finally hitting the bottom line. But two, and this is interesting, they got much better margins than they expected on the hardware they did sell.
So they're squeezing more profit out of the old business while building the new one.
Exactly. And that really sets the stage for the biggest news of the quarter, which they kind of dropped right at the end of their commentary.
It's Chipotle deal.
The Chipotle deal, a 6-year exclusive agreement. They're expanding a partnership that's already 25 years old.
And this isn't just renewing a contract. This is a full rollout of their new tech, right?
A full rollout. The new Aloha next-gen point-of-sale system and all the supporting apps across 4,000 of their restaurants around the world.
Landing a name like Chipotle for a brand new platform, that's a huge vote of confidence. Management called it a watershed moment.
It is. It's the clearest validation you could ask for of their new Voyix commerce platform, the VCP, and specifically its microservices architecture.
Okay, you just said the magic word. For those of us who aren't software engineers, what does microservices actually mean for a company like Chipotle? Why is it a big deal?
It really boils down to speed and resilience. The old way of doing things was this one giant piece of software, a monolith.
Right, and if one part breaks, the whole thing goes down.
Or if you want to update, say, the loyalty program, you have to test and deploy this massive clunky update. It could take 6 months. With microservices, the software is broken into hundreds of tiny independent functions.
So you can just update the one little piece you need to.
Exactly. They can push out updates or new features almost daily without any risk to the core system that's taking orders. For a company like Chipotle that needs to move fast, that's a game changer.
That makes total sense. It's all about agility. Okay, so let's break down the 4 pillars of their strategy, starting with how they're getting rid of that hardware headache.
Right. Pillar 1 is de-risking hardware. They're outsourcing their manufacturing to a new partner, an ODM called Enacom.
And when does that kick in?
The transition starts in January 2026. They think it'll take about 90 days to complete. And here's the crucial part. By the beginning of Q2 2026, they'll move to a net accounting basis for hardware.
Okay, break that down for us, net accounting.
It's huge for how investors see the company. Instead of reporting massive low-margin hardware sales on their top line, they'll just report the net fee or commission they get.
So the ugly low-margin revenue just disappears from the income statement.
It disappears, and overnight, their reported gross margin profile looks much more like a software company, which is what they want to be.
So they're cleaning up the books while freeing up capital. That leads to pillar 2, which seems to be about getting paid what they're worth.
That's a good way to put it, price discipline. For years, their contracts, like 5 years for retail, 3 for restaurants, didn't always have price escalators. Or if they did, they weren't billed.
That's just leaving money on the table.
A lot of money. Now, on every renewal, they're adding what they call cost of living plus something escalators.
I loved that one quote from the call about charging appropriately for supporting very tired old legacy applications.
That says it all. It's about monetizing the fact that it's really, really hard for these big clients to switch away from them.
Okay, but the real explosion in their market opportunity comes from pillar 3, payments.
Oh, this is a whole new ball game. They're going deep into payments, and it's being driven by these new long-term deals for commercial fleet card acceptance.
Fleet cards. So we're talking about the payment systems for truckers, delivery companies.
Exactly. With two of the biggest providers in North America, Corp and WEX. This is a highly specialized, very complex part of the payments world.
And why is that such a big deal for Voyix?
Because now they can be both the point-of-sale provider and the full-service payments processor at over 18,000 fuel locations.
Ah, so they're offering a single, unified solution.
Yes. And customers love that because it gets rid of all the integration headaches and finger pointing you get when you have separate POS and payments vendors.
Yeah.
The scale of this is just staggering.
Give us the numbers. What's the new TAM, the total addressable market?
Their new estimated U.S. payment TAM is $1.4 trillion in volume.
Wow.
And that's broken down into about $600 billion from that specialized fuel gateway and another $800 billion in regular consumer card volume. They can now monetize every single transaction that flows through their ecosystem.
That's an incredible growth engine. Which brings us to Pillar 4, the tech itself, the VCP platform that won them the Chipotle deal.
Right, the cloud-native microservices core. What management stressed is that they're not building this from zero. They're using what they called their massive collection of codified industry wisdom.
Which means all the software they've built over the last 30 years.
Over 50 proprietary applications. And they're using AI-enabled development to speed everything up.
And we saw that paying off with other customers this quarter too, right?
We did. 3 big grocery brands went live on the new POS application, which will ramp up next year. But the best example of flexibility was with HEB.
Right.
HEB actually has its own in-house POS software, but the VCP's loyalty module was able to plug right into it. It showed the VCP doesn't have to be a full rip and replace. It can be a high-value layer on top of what customers already have.
You know, this whole theme of moving from low-margin commodities to high-margin proprietary assets, we see that everywhere.
It's a classic strategic playbook. A perfect parallel is actually in the pharma space. Look at a company like Amphastar. They also just reported Q3. And on the surface, the numbers looked messy. The adjusted numbers beat expectations, but their JAP results looked really bad.
Why was that?
It was messy. They took a big one-time $23 million litigation charge and another $5 million in upfront R&D for a licensing deal. These were big investments that just crushed their operating margins for the quarter.
And the market reaction was probably negative at first.
It was. The stock sold off over 4% right away. But then something interesting happened. Investors dug in and saw the underlying story.
Which was?
Their key proprietary drug, Baqsimi, was up 33%, while their old generic stuff was declining. Investors realized the messy quarter was just masking this powerful shift in their business mix. The stock rebounded and shot up 12% over the next few days.
So just like Voyix taking a $100 million restructuring hit, Amphastar took some short-term pain on their P&L to fund a long-term pivot to a much higher quality business model.
It's the exact same playbook. You're investing in building a defensible moat around your business.
Let's bring it back to Voyix. What are their customers saying about the economy? Retailers, restaurants, they're getting squeezed. Are they still spending on tech?
Management said spending is still healthy, but it's very targeted. It's not tech for tech's sake.
So what are they focused on?
2 things. First is revenue acceleration, using loyalty programs and unified commerce to get a bigger share of the consumer's wallet. The second is just pure efficiency.
Cost control.
Yep, using automation to deal with labor shortages and using tech to cut down on waste and theft. Technology isn't a luxury right now. It's a survival tool.
So let's talk about their guidance. How did this all shake out in their outlook for the full year?
Well, this is the impressive part. Even with all these front-loaded costs, they actually raised their full-year adjusted EBITDA guidance. It's now $420 to $435 million.
They did slightly lower the revenue forecast, though.
They did, but it was for technical reasons, just some timing adjustments from customers related to software implementations that were delayed last year. Nothing structural.
And the total cost for this whole pivot is still about $100 million for the year.
That's right. About $100 million in cash restructuring costs. And that's the key insight. They are absorbing $100 million in costs, funding this massive transition, and still raising their profit forecast.
Which means the underlying business is performing even better than planned.
The operational leverage is kicking in faster than anyone expected, and their balance sheet is still solid, with net leverage at a conservative 2.0x.
Okay, they're pulling off a major overhaul from a position of strength. Which brings us to my favorite part of the show. This is not financial advice.
Uh-oh.
You've laid out the whole story, the numbers, the strategy, the catalysts. What's the outrageous but plausible trade idea you've cooked up?
Okay. The outrageous bet is to go long NCR Voyix based on a multi-year sum of the parts thesis.
Meaning the company is worth more in pieces than it is together.
Right now, yes. The market is still valuing it as this blended, messy hardware plus software company, maybe at, 8 or 10 times EBITDA.
And the catalyst is forcing the market to see the pieces for what they are.
Precisely. Management is already doing the work. They're operationally separating the hardware business. They're commercially focusing on the high-growth payments and VCP software business. The outrageous part is the timing.
Go on.
I'm projecting that once that hardware transition is done in mid-2026, and once they've proven they can monetize even a small piece of that $1.4 trillion payments market, the board will immediately announce a formal spinoff or sale of the payments division.
And that would get a pure fintech valuation.
A pure fintech multiple. Those businesses trade for 20 times EBITDA or even more. The spinoff would unlock that valuation, and I think it could drive the overall stock 30 to 40% higher as all this restructuring noise finally fades away.
So the trade is to buy now before the spin-off narrative really starts to take hold next year.
You buy now before the complete re-rating of the business model.
It's a bold call, but it's grounded in the strategy they're laying out. So, to recap, Voyix pivot is working, the Chipotle deal is a massive proof point for their tech, and the payments opportunity is the real growth engine to watch.
And the final thought I'd leave you with is this. Think about the competitive landscape. What happens when a newly focused giant like Voyix starts flexing its muscles with things like price escalators and a unified payments platform? What does that mean for all the smaller players in that space?
That's a great question and definitely something to keep an eye on. Thanks for joining us for this deep dive. And a reminder to everyone listening, this is for educational purposes. Always, always do your own due diligence.